Bitcoin is surging. The world's largest cryptocurrency is showing significant strength today, painting the market green after a period of downward pressure. In a powerful display of bullish momentum, Bitcoin's price has climbed by an impressive 2.10% over the last 24 hours. This recent rally has pushed its value to a staggering $87,924, which translates to approximately 1.46 billion Indonesian rupiah. This sharp upward movement has captured the attention of traders and investors globally, sparking conversations about a potential new phase of market recovery and growth. The green candles on the daily chart are a welcome sight for many, signaling renewed confidence and buying activity in the crypto space. However, zooming out to a wider time frame reveals a more complex and nuanced picture. Despite the encouraging daily gains, the weekly chart tells a story of struggle. Over the past 7 days, Bitcoin has actually experienced a period of decline. The market sentiment was noticeably more bearish, with red dominating the charts as the price trended downwards. This weekly weakness serves as a critical reminder of the market's inherent volatility and the ongoing tug-of-war between bullish and bearish forces. The recent spike, while positive, is still working to overcome the negative momentum established over the past week. So, what does this mean for the future of Bitcoin? We are currently at a fascinating crossroads. The strong 24-hour performance injects a dose of optimism, suggesting that buyers are stepping in to defend key support levels and drive the price higher. On the other hand, the lingering weekly downtrend indicates that sellers have not yet been fully exhausted and that resistance levels overhead could prove formidable. This juxtaposition of a green day against a red week creates a sense of uncertainty. Is this a genuine reversal and the start of a sustained uptrend, or is it merely a temporary bounce within a larger corrective pattern? The market holds its breath, waiting to see which trend will ultimately prevail.
Is the Bitcoin bull run over? Let's break it down. Over the past few weeks, we've seen the market go on a wild ride. Bitcoin's price has been a roller coaster, with sharp climbs followed by gut-wrenching drops. News channels are buzzing with talk of market volatility, and every trader seems to have a different opinion. One minute, headlines scream about new all-time highs. The next, they warn of an impending crash. This kind of chaos can be nerve-wracking, especially for those new to the crypto space. It's easy to get caught up in the fear and uncertainty when you see the price charts flashing red across the board. The constant stream of conflicting information from analysts and influencers only adds to the confusion, leaving many to wonder if they should sell everything and run for the hills. This brings us to the recent correction phase. After a period of incredible gains, the market has pulled back significantly. We've witnessed a steady downward trend, with prices falling from their recent peaks. For many, seeing a sea of red on their portfolios is a cause for alarm. It feels like the party is over, and the bears have taken control. This is the point where panic selling often kicks in. Financial analysts are poring over the data, their faces etched with concern as they try to predict the market's next move. Every dip feels like a freefall, and the psychological pressure can be immense. It's a classic test of an investor's resolve, separating the paper hands from those with long-term conviction. This phase is a natural and necessary part of any market cycle, designed to shake out weak hands and reset expectations. However, if we zoom out and look at the bigger picture, the long-term bull structure remains firmly intact. Despite the recent dip, the foundational support of this bull market is still holding strong. Think of it as a solid base that has been built over months of steady growth. While the short-term price action might look scary, the underlying trend is still pointing upwards. This bull market support band has been tested before, and each time it has proven to be a reliable floor for the price. The fundamental drivers of this cycle, such as institutional adoption and increasing mainstream acceptance, have not disappeared. The dip we are experiencing is a correction within a larger uptrend, not the beginning of a new bear market. The macro-level indicators are still overwhelmingly positive, suggesting that this is merely a pause before the next major leg up. Of course, this doesn't mean we are completely out of the woods. There is still a possibility of a deeper drop before the market finds its true bottom. Some technical analyses suggest that we could see another 35% correction from current levels. A move like that would certainly be painful and would likely trigger another wave of panic. However, history shows us that these deep, final capitulation events are often the precursors to the most explosive rallies. A sharp, V-shaped recovery typically follows such a cleansing, as smart money rushes in to buy the dip at deeply discounted prices. This final shakeout is what often lays the groundwork for the next parabolic advance, clearing the way for a more sustainable and powerful move to the upside. So, what comes next? Once this correction phase is complete and the market has shaken off the excess leverage and weak hands, we can expect the next bull run to begin in earnest. This next leg up has the potential to be the most explosive one yet. Picture a rocket preparing for launch. The final countdown is underway, and all systems are go. We could see Bitcoin's price chart go vertical, smashing through previous all-time highs and entering a new phase of price discovery. The combination of strong fundamentals, renewed investor confidence, and a reset market structure creates the perfect storm for a powerful continuation of this bull market. The journey has been volatile, but for those who can hold on through the turbulence, the destination promises to be spectacular.
In the world of cryptocurrency, prices move fast. But Bitcoin's recent dramatic price drop wasn't just normal market volatility. It was a violent, rapid, unwinding event known as a long squeeze. So, what exactly happened? And how did billions of dollars get wiped out in mere hours? To understand this, we first need to look at the derivatives market. This is where traders don't just buy and sell Bitcoin, but make bets on its future price using complex financial products like futures and perpetual swaps. A key strategy here is the long position, a bet that the price of Bitcoin will go up. To amplify their potential profits, traders often use leverage, which means borrowing funds to make a much larger bet than their own capital would allow. For example, with 10x leverage, a $100 investment can control a $1,000 position. It magnifies gains, but it also magnifies risk. Here's where the danger lies. If you're in a leverage long position and the price starts to fall instead of rise, your position can be automatically closed by the exchange to cover the loan. This is called a liquidation. Now, imagine this on a massive scale. This initial dip is enough to trigger the first wave of liquidations for traders who used very high leverage. Their positions are automatically sold. These forced sales create a sudden surge of selling pressure in the market, pushing the price of Bitcoin down even further. The new, lower price now triggers liquidations for another group of traders who used slightly less leverage. Their forced sales push the price down again, faster and harder. This creates a brutal feedback loop, a domino effect where each wave of liquidations triggers the next, causing the price to plummet in a violent cascade. As the price began to dip, over-leveraged traders were caught off guard. In a 24-hour period, data showed that over $1.8 billion worth of long positions were liquidated across derivative exchanges. We saw Bitcoin's price fall sharply as this cascade of forced selling flooded the market. So, the next time you see a sudden, dramatic crash in Bitcoin's price, remember it might not just be sellers outnumbering buyers. It could be the invisible, powerful force of a long squeeze, a structural washout of excessive optimism and leverage, reminding everyone of the inherent risks in the high-stakes world of crypto trading.